and today we will be joining Mr. Akindaudu of Citibank Nigeria Limited for an interview. Stay tuned. My first question to you is about the Nigerian FX markets. It's been going a lot of stress point lately because of the lower oil prices and the pullout of offshore investors.
Well, forecasting currencies is a very difficult business, and unfortunately I don't get paid enough to accurately do it. Very few people do. I think the bottom line though is that the Naira is under pressure for a number of factors, the drop in oil price, as everybody knows, and that has occasioned, that has contributed to the pullout of foreign investors from the country and their investments in the country. And I think we're in for a period of increased volatility in the currency, and yes, possibly greater weakness. How far that's further with greater weakness in the currency. Now, how far that weakness extends and how far the rate goes, it's very difficult to judge at this point.
Okay. It's been estimated there are about 8.5 billion of offshore funds in Nigerian fixed income securities. This is as of June 2014. How much of that is left and how much of a sell-off do you think we will see, especially in 2015?
I think we've already seen a significant sell-off.
Okay.
I think part of the problem here is the data challenge that we have in general, which is that we don't know exactly how much foreign portfolio money is in the country. The central bank doesn't say.
Okay.
We estimate, and I think your figure is pretty consistent with the estimates I've heard as at June.
Okay.
Right? How much has run off since? Tough to estimate. What I will say is there have been significant investments coming through the JP Morgan bond index that Nigeria was included in 2012. And passive investors who track that index simply replicate the index on a grand scale. And that suggests that if they're perfectly weighted, there should be about $5 billion of that money in Nigeria, if the weighting is correct. If you assume that some of that investment has dropped off and that these investors are now underweight Nigeria, maybe there's 4 billion of that money left, maybe 3. We think or I think certainly that figure may be the bottom, maybe the lower end of the range where the foreign investors in fixed income will drop to.
3 billion?
Yes, 3-4 billion. I don't think it will go to zero like it might have done in the past.
Okay.
Because those investments are stickier by nature. They are replicating an index. So if the index says you put X% in Nigeria, many of those guys will simply put that X% in Nigeria. And unless things get extreme, they're likely to stay. So I would say if we're at 8.5 in June, roughly, I would say probably about half of it has run off now.
So what do you think will make the Naira stabilize, or do you see significantly higher yields or interest rates, or?
I think the marginal utility of monetary policy tightening is close to an end. I don't think there's much more tightening that the monetary policy can do that would materially help the currency at this point. I think monetary policy has worked well since this current tightening regime started in September 2010 and really picked up momentum in October 2011 when CBN, MPC spiked the MPR by 275 basis points. And that has helped to attract foreign portfolio investment and keep it in and stabilize the currency while it bought time to build fiscal buffers. Fiscal buffers haven't been built. And at this point, with oil prices going south and the lack of significant inflows into the coffers, the FX coffers of the government, it's difficult to imagine that significant tightening will particularly attract any more money or help to protect the currency too much at this point. So the sense is we're in for a period of greater volatility. I think monetary policy tightening has done what it can, but it can only treat secondary effects. The underlying structural issues remain. Monetary policy can't fix that. So I doubt that further tightening will be of significant use to the currency. And the more you tighten, the more damage potentially you do to the local economy. And relative to the benefits you will get in terms of currency stability, I think we've reached the point where monetary policy tightening is close to running its course.
In terms of liquidity, in the fixed income market, what has been happening and what do you think we will see in the coming year?
Well, I mean, the market has been, you have to remember, the federal government did not issue any bonds between 1988 and 2003.
Okay.
Then, after issuing the bonds in 2003, the secondary market was initiated and primary dealers were appointed in 2006. So the Nigerian bond market as we know it, the secondary market, the fixed income market, is less than a decade old, it's 8 years old. And I think great progress has been made in that time. There have been ups and there have been downs, but progress has been made. We now have a deeper, more diverse market with banks, discount houses active, but unlike 7 years ago now, the pension funds are big players. And portfolio investors are also big players. So banks and discount houses, after having learned some lessons, are playing their role in the bond market better. Banks and discount houses should not be the main buyers of duration risk or bond risk. It really should be long-term investors like the pension funds and to some extent portfolio investors. And that equilibrium is now being reached. Liquidity is pretty good. I think we do about $200 million a day, something like that. But there's room for great improvement and depth for Nigeria to really be an international class bond market. And some of those things are going on via the FMDQ, which I think you'll be aware of, and the rules they're putting in place and the product development they're trying to drive. I think a key frontier now is the setting up of a repo market, which should create greater liquidity, not just in the money markets in terms of the ability of people to borrow and professional counterparties to lend to each other in a secure manner, but also in terms of creating trading liquidity. The repo market allows bond traders to run short positions as well as long positions. And that creates more liquidity and more trading activity regardless of which way yields are going. When yields are dropping, there's often liquidity because everybody's long bonds and they're making money. But when yields are going up, it's historically difficult to take advantage of that because you can't run quote-unquote a short position. A thriving repo market allows you to do that. And it means that liquidity in the market will not dry up when yields go up and in times of crisis. So I think that's a key landmark for 2015 that must be attained if the bond market is to take the next step.
What are some of the structural inefficiencies that you think we're still dealing with in our market?
I think there are two things there. I don't think it's automatic to assume that if bond yields do not reflect drops in inflation on a month-by-month basis, that it's reflecting an inefficiency. I think that's it's an assumption, if it's not necessarily correct all the time. There can be other factors at play. For instance, people might perceive the drop in inflation to be temporary and short-term, or not significant, and may think the longer-term price pressures are building. Bonds are 3, 5, 7, 10-year instruments. You shouldn't price them too much on the basis of 1 month movements in inflation. If the long run or medium-term outlook for inflation is upwards, then a short-term dip may not make a difference to the bond prices. So that's one factor there. But that doesn't mean that there are no inefficiencies in the market. Like I said, the market is relatively young, but we're getting better all the time. Rational actors help. The banks are no longer dominating the market as they did 4 or 5 years ago, which was bad for the banks and bad for the market. Other players are there, and these guys price risk more rationally and have a longer term outlook, right? And because of that, they make more intelligent decisions. Inefficiencies, I mentioned the repos and the inability to run short positions earlier. That is one issue. That means that changes in the macroeconomic variables don't smoothly reflect in the bond market. Other things include there are no derivatives, again, which again make it difficult to hedge risks and again to take rational decisions. So those would be a couple of the things. Information deficits is a big deal. I mean, any market is only as good as its information because there's a lot of information that is not readily available all the time. What you find is there's information asymmetry, which is some people have information, others don't. The regulator has information, the players don't. This player has more information than that player. And when you have information asymmetry, what you have is inefficient markets. So a key infrastructure challenge is to improve the quality of information available and to improve the access to it across the board. And that is something that we have to produce economic data as a country, and we have to put it out there, and it has to be accurate, and it has to be timely. And that allows people to make better decisions and make better calls as well. Professionalism is also an issue. I think the secondary market in bonds is improving. We are more professional than we were. We're getting better. We're more professional. I believe the OTC fixed income market is more professional than any other market in this country. But there's always improvement that can be done. People have to understand what it means to trade and have to understand what it means to provide liquidity into the market at all times.
In the sense of the recent sell-off in the markets, what do you think Nigeria can do to mitigate the downside risk of being integrated with the global market?
It's one of those questions like, well, I want the good bits, but I don't want the bad bits.
Yeah.
I'm afraid you have to take the rough with the smooth. Being part of the world means that you're connected to what goes on. The question really should be, do we want to be integrated with the rest of the world, or do we not want to be? I think the answer is that we want to.
A lot of the financing has been to finance the big ticket oil and gas deals, the power sector deals. That's what a lot of these Eurobonds have been used for. Again, I have to ask you to look in this crystal ball. What other aspects of the Nigerian economy do you see banks going to finance with like dollar-denominated debt?
Well, you see, you have to look at the macroeconomy and figure out what's going on. And then from there, you'll know what people are doing. Like you said, energy. Nigeria is an energy country. Nigerian banks have historically not been involved in financing production in the oil sector. Only recently has that started to change. And one of the reasons why it's that changes the access to financing like this. And so there's plenty of room there, I think, for further activity. Because really, Nigeria is an oil country. Nigerian banks should be much more involved in that type of financing. We should be acquiring the skills, which we're doing, and the capacity to do that funding. So that's going on. Power is the new frontier. And I think there will be plenty, more than enough in power to occupy Nigerian banks for the next few years as the regulatory environment settles down post-privatization and the interim period gives way to the transitional electricity market and ultimately to the full-blown BAU electricity market. There will be plenty of funding needs. The infrastructure requirement is huge. The cost requirement in power to bring Nigeria anywhere near where it ought to be is gargantuan, for want of a better word. And clearly, then people are going to be raising a lot of money if that is to succeed, because the government can't fund it, which is the whole point of the privatization anyway. So we have to find investors and private sector people who will do it. And I think banks will be involved in that one, locally, foreign banks, everybody will be involved in that one for years to come. And that's good. I hope that turns out to be the case, because that means the reform is working and that progress is being made.
Thanks for your time. Until the next time, this is Business Day.